Kumar Subbiah, CFO of CEAT Tyres joins us now. Kumar, good morning. Thank you for joining us. Let's first understand the sector per se. A lot of tailwinds have come back, whether it is on the demand side, also on the raw material side, and also in terms of where the replacement market is moving. Do you see that next 6 to 12 months for the tire industry per se could be strikingly different from the last 6 to 12 months?
On the commodity side or raw material cost side, there has been some stability in the prices, unlike the previous 8 quarters. So the material prices have been moving within a range. Okay, crude, for example, has been moving within a range of $75 plus or minus $5. And natural rubber for last 1.5 months has been moving within a range. Though prior to that, the local rubber prices moved up. So on the margin side, where the raw material plays a role, okay, should the commodity prices remain within a range, okay, we expect there's some kind of stability in the margins. As far as the revenue side, normally in summer months in the local market we tend to sell more as the demand is higher. Exports is slowly recovering, though it's not gone back to where it was, say, prior to Russia-Ukraine war. And as far as OEM demand is concerned, the demand has been good from commercial category, but in case of two-wheelers and some other categories, the demand has been, I would say, stable. That's the way I would like to sum it up.
So stable demand is what you're pointing out, at least nothing incrementally negative. But talk to us about your market share targets as well, both for the two-wheeler segment as well as passenger vehicle. You have quite ambitious target for market share gain. How do you expect to kind of scale up? Are you looking at new launches? Are you looking at deepening the presence? What's the strategy?
Okay, and see, for us, passenger is core. Okay, passenger categories of tires, basically passenger car and two-wheeler categories are core to our strategy. So from that point of view, as far as two-wheelers is concerned, and in the replacement market, we expect our market share currently to be in the range of around 27-28%. We would like it to inch up closer to about 30%. That's our short-term and medium-term plan. As far as passenger car category tires are concerned, currently we are closer to about 15% kind of a market share in the replacement market. Okay, and we would like to take it up to around closer to about 18% in the 2 to 3 year kind of a time frame. And we have built adequate capacities to meet the requirements, and we are working in terms of developing new products. Entries into various OEMs is also one of the levers that would help in getting some growth in the replacement market. And we continue to be present in growing categories like EVs, where we are making efforts to ensure that we gain some reasonable share. So those are some of the steps that we're taking.
Mr. Subbiah, I also wanted to understand, when it comes to exports, what's your strategy? Because there as well, you're sounding pretty optimistic and bullish, and you're looking to double your revenues by FY26. What's instilling this kind of confidence? And more importantly, are you looking at further investments? Are you looking at exploring some M&A opportunities?
Last 2 to 3 years, we have been growing strongly in exports. Okay, and in the overall, our revenue share, exports used to be around 12 to 13%. Okay, in the FY22, we reached a level of about 20%. Okay, and FY23 was relatively a weak year for exports, and therefore our revenue share was more or less in line with the previous year, about 19% or so. In terms of your question with respect to what are our strategic actions, one is that our specialty tires, which is agri-radial tires, where we build capacities and we would like to grow strongly. And we have been growing strongly on a small base. Second, we launched our truck and bus radial tires in Europe market last year, July, which we would like to scale up. And our passenger car exports to Europe and other parts of the world has been progressing well in line with our plan. And towards later part of this year, towards the end of the current financial year, we also intend to enter US market for both truck and bus radial and passenger car radial tires. So these are the levers that we expect our revenue share to go up from current level to closer to about 24-25% over a 2 to 3 year period.
Okay. How much demand do you see is coming back from the pure replacement market?
No, replacement market demand is a function of what is happening in the economy. Okay, and different categories of tires are have different demand factors. So, in case of commercial categories of tires, we are seeing some good growth, good demand for the last 6 months or so. Commercial categories faced issues in the previous 2 years; they were not able to grow. In case of passenger car, we are seeing growth. In case of two-wheelers, the market is still kind of flat. Okay, so that's the way I would like to split the replacement market demand. So to just sum it up, commercial category is growing well. Passenger car is also growing. And in case of two-wheelers, it's kind of a stable.
Subbiah, just before we let you go, I know you gave a bit of color on the margins already, that the raw material pricing is stabilizing, but help us understand a few more details. The analysts are penciling in a number of almost 13% when it comes to margins of FY24, and that compares with around 9 to 10% which FY23 clocked in. Do you think that's a realistic number, 13-14% for FY24?
It's difficult. We normally don't guide, okay, but however, we can give you some indicators. And in the quarter four, we closed the quarter four closer to about 12.8% kind of margins. On an overall full year basis, our margin was about 8.8%. Okay, and generally we are comfortable in a two-digit kind of margins. If raw material prices remain within the same range, and if you are able to hold on to our final product prices, okay, and we would be in that range, comfortable range of about 11-12%. As far as quarter one is concerned, generally our marketing cost is a little higher because we spend more money during IPL. So that needs to be factored in as far as quarter one is concerned. Otherwise, I think we are in a comfortable range. It's difficult to forecast what will happen to commodity prices as it influences the margins. So therefore, we are in a comfortable range. I'm not able to tell you we would be at 13% or at 12%. We would like to wait and watch.
Sure. Since you did mention IPL, would it be fair to assume that the marketing and ad spends will only be higher as the year progresses?
No, in quarter one, obviously, we are more active with respect to IPL, and therefore we spend more money. And our advertisement cost also, the amount of money that we allocate also depends on how the business is doing, our normal margins that we get, what happens to our costs and things like that. When we want to focus on passenger category, it is important that we spend adequate money on sales and marketing. So therefore, we expect our advertisement or our marketing cost to be higher this year, both in absolute terms and also as a percentage of turnover compared to the last year, if you are able to maintain the quarter four level kind of margins.
All right. Really appreciate your time, and thank you for joining us with your update.